MF Global's chief economist Jim O'Sullivan sees the light at the end of the tunnel. He says he is, in fact, seeing improvement in the rental market, and that will eventually lead to higher home sales over the next year. Jim's here in business with us this morning. Jim, I feel like the only people who tell us that they're seeing signs of hope in housing are economists and realtors. Anyone who's trying to sell or buy a house right now still tells you things are grim.
Well, the state of housing right now is very weak, no question. But the big plunge in home sales clearly ended 3 years ago. And you look at the data through all the ups and downs month to month. And every time there's a down, of course, people talk double dip. But when you look at the annual averages, existing home sales have been within 100,000 of 5 million in each of the last 3 years. Last year was 4.9 million for the year as a whole. The latest monthly number for March of 2011 was 5.1, so
and yet
basically flat.
We are seeing prices decline in these last few monthly data points.
Yes. Now, price numbers are generally at new lows, not by a lot. They had risen from early 2009 through early 2010, helped by the tax credit and some compositional effects, and that's being unwound to some extent over the past year. But the net of it is home prices are down slightly from 2 years ago. The loan performance number that came out yesterday was down 7% year over year, but it was up 3% in the previous 12 months. So again, it's about 2% a year for the last 2 years, which is negative, but compared with the huge plunge we saw earlier, really the big drop is behind us.
Well, explain your rental theory here. Is this sort of a rent to own? People are renting and considering pulling the trigger?
Not so much. I mean, ultimately it goes back to employment. I mean, the real key to the recovery is a pickup in employment. Obviously, that's the key for a self-propelling recovery where employment leads to spending, leads to employment, and so on. And ultimately, that's the critical element for housing as well, because as employment picks up, household formation picks up.
Even more so than credit and lending.
I mean, there's not going to be a sudden change in credit availability. Lending standards for business loans and consumer loans are being eased at this point, clearly. But for mortgages, if anything, they're slightly still being tightened. Not a big change compared with where we were. But ultimately, as employment picks up and consumer confidence picks up, we've already seen the increase in household formation lead to an increase in rental demand and rents in the CPI. And ultimately, with more of a lag, obviously it's a bigger commitment, we'll see the home sale numbers pick up as well. But again, the key clearly is a sustained pickup in the labor market.
And you are seeing upward momentum in your analysis in the labor market. Are we going to see jobless claims that reflect that?
Well, I mean, obviously the payroll numbers last Friday were very encouraging. You look at payrolls so far this year, up 192,000 per month. April alone was 244. Other numbers, if anything, suggest even more strength than that the data might have been undercounted. Now, on the flip side, of course, the last 2 weekly claims numbers have raised the possibility that momentum could be going down again. So there's a bit of noise here. And frankly, what happens to the claims numbers over the next few weeks will be very, very important.
Can we say it's noise at this point, or are you starting to wonder if we are seeing a downward trend with the state workers, federal workers getting cut back? It's
not definitive. I mean, if they're picking up, it's not because of state and local workers. I don't think that's suddenly changed. I mean, there are issues with Japan crises and supply chain effects. There was something special with New York last week. So there are clearly special factors. Whether they fully account for the rise, we're not sure yet.